We are at the NASDAQ market site today for the 40th anniversary of the NASDAQ 100 index. Now, you probably know this tracks the 100 largest non-financial stocks on NASDAQ. 94 exchange-traded funds track the NDX, that's what we call the NASDAQ 100, in over 20 countries, including the Invesco Triple Qs. That is the 5th largest ETF in the United States. Let's talk with Nelson Griggs. He's the president of NASDAQ. He runs the place. And with Todd Sohn, head of ETFs for Strategas. Nelson, NASDAQ 100 is synonymous with tech, but today we have this big news story. This China firm, DeepSeek, reportedly launching an AI model at considerably less cost than the U.S. models. You're the keeper of the NASDAQ 100. Yeah. What does this mean for that? What does it mean for NVIDIA? What does it mean for Microsoft? What does it mean for the whole group?
Well, a couple things. I'll take a step back. So the NASDAQ 100, again, 40 years, averaging 14.25% compounded yearly returns. So it has a great long-term track record. It's 60% technology, 20% consumer, the rest healthcare and industrials. So it is a little more diversified than you would normally think. But if you do look at the news story of the day, you know, there's a lot of companies that are attached to AI in the NASDAQ 100 for sure. So it is seen obviously a downturn today. But those companies are the innovators of the world. They're going to have to get through this moment, and I think you look at their track record, and they've got a great story of doing that, and we'll see how they all adapt.
Yeah, there's all this talk about lower capital expenditures. Isn't lower capital expenditures good for the AI story? I mean, lower capital expenditures make it more accessible and faster and easier for other companies to adopt AI. At least that's the way I would look at it. I mean, maybe
it'll be a story to play out on an individual company basis, because some companies will certainly benefit from a lower cost of capital when they think about the R&D efforts, and others that are more directly in it will have to, again, they're innovative companies that we've seen them get through any sort of difficult times over the years. They've shown they can do that. So.
Todd, let me bring in you. I often go to you. You're my resident ETF guru on all things. The NASDAQ 100 is one of the most successful indexes of all time. Most people don't know it launched 40 years ago. The Triple Q NASDAQ 100 ETF launched in 1999. Prior to that, people ask me all the time, you really couldn't invest in the NASDAQ 100. You had NASDAQ 100 futures, right? But that wasn't easy for an average person to invest in. So essentially, QQQs launched in 1999, as I recall. There is an astonishing universe of products around the NASDAQ 100 ETFs, 94 of them, Nelson told us about earlier. Why is this product so successful? And it didn't just happen this year. This was not 2023. It's been successful for a long time. So
when you think about the NASDAQ 100, I would put it on the Mount Rushmore of indices, right? Performance and the ecosystem, the measurements of that. The performance has been fantastic, and now, because it's been so successful, you have issuers out there in the ETF space wanting to take advantage of the ecosystem, right? Of the constituents involved in that. So I can get plain vanilla, I can get equal weight if I'm worried about concentration risk. I can go super concentrated now and just get the top of the Qs, or I can sell covered calls on it, right? There's so many different ways to get the power of this index, and as we always like to say, ETFs are about access, right? So the Qs gave you access to the NASDAQ 100, and now the ETF ecosystem gives you access to all these different strategies involving those constituents.
Go ahead. Tell us your product here. I mean, that's a very good introduction.
I think that's an amazing introduction, but we have an incredible team here that we are investing a lot more in than ever, because it is a partnership. So companies come to us, firms come to us, whether it's Invesco, First Trust, great partners of ours, or we go to them and bring ideas, and that team helps construct all these wonderful products. And I think the demand we're seeing, obviously you saw heavy demand in retail, but now it's branching out into wealth channels, it's branching out into institutional insurance products, and as you mentioned earlier, Bob, global. So we still think we're in the pretty early inning years of what the index can become.
There is an astonishing amount of derivative products and leverage products around this. So I'm looking today at the biggest volume ETFs that are out there, and I see things like the ProShares Triple Q 3X. That means you get 3 times. If it's up 2 times, you get 6%, 2% you get 6%, and the ProShares Ultra Pro Short Triple Q, which is 3 times inverse here. Yeah. Both of them are among the heaviest volume ETFs. I think they're 1 and 2, and then maybe the semiconductor ETF. So there's just one simple product, leverage and inverse products, and there's dozens of others that are around them at this point.
I even think more impressive, right? So the Qs are a top 5 ETF in terms of assets. The mini QQQM, right, slightly cheaper version, is the 40th largest ETF, and it just came into existence less than a decade ago, maybe 5 years ago. So that just shows you how in demand this index is, right? So you can go for the liquidity vehicle that is triple Qs, or if you want, say, the more advisor-friendly option, QQQM. And then the leverage products just speak to how popular this is. People want exposure to this, especially if you get a market shakeout, kind of like what we're seeing today. I would guess tactical folks are going to start piling into the leverage long product at some point, especially once conditions really wash out within the market.
Yeah, so we also have the latest spin-off, the Invesco Top QQQ. This is sort of the largest names in the NASDAQ 100. The symbol is QBIG, folks. And of course, that didn't launch. That launched only a short while ago. On top of
that's part of this theme of super concentration, right? So you have single stock leverage ETFs, and now you have top of the index ETFs. And I think it is curious. Maybe we're going a little overboard in terms of skewing away from diversification. Maybe I want the healthcare and industrial exposure that the Qs offer, as opposed to saying go super overweight into that top 8 to 10 names. But again, it's all about access.
Where do you
convenience.
fall in? I know you're not an index strategist. You run NASDAQ, but this concentration story is an interesting question. I personally don't worry about it that much because if you have a broad index like a NASDAQ 100 or even an S&P 500, some stocks are going to be more valuable. That's the market talking. But is there risk here in having the top 10 S&P companies are 38% of the weight? Is there?
I think, as you said, about it's the market talking, and I think if an investor said that's all I'm buying, yeah, there's going to be more inherent risk with that person's portfolio. But I think there's a lot of education in the marketplace today. If you look at go to Invesco's website or all the other providers we work with, they do an enormous amount of education. Yeah. So I think that's what the investors, they would not put these products in market if they were not in demand. So that's the first step. And then if they don't get the traction, they know to shut these things down. So I think there's it's individual call and making sure they're diversified, not a company saying let's go buy.
And of course, people keep telling me we're only giving people what they want, Bob. So now we have these whole spate of single stock ETF products. And there's an NVIDIA leveraged ETF product. It's got huge volume today. There's NASDAQ leverage products, 100 leverage products. On days like today, that's an awful lot of stuff to move around here, and of course some of this is synthetic, but does any of this pose any systemic threat to the system? Remember what happened a few years ago with the volatility ETFs?
I don't know about systemic, because there's still a small slice of the overall ETF spectrum. Their usage rate is certainly climbing, right, in terms of the dollar volume, but the amount of dollars on brokers' books is microscopic compared to just, say, the actual QQQ or any of the other passive vanilla products that are out there. So I'm not terribly worried about it, but you might see a story here or there where a wrong bet was placed and a firm is going to struggle from now on. Yeah. Right? They'll have to repair themselves.
What do you think the market leaders are going to be a couple of years from now? And again, I don't want to put you on the spot. I know you're not a tech analyst, but I'm going to give you a chance to talk about the NASDAQ, the junior ETFs, the QQQJ. Now, they launched this product about 4 years ago. I actually had you guys on at the time. That's the NextGen 100 one. Yeah. I call it the NASDAQ 200. It's essentially the 100 non-financial stocks that are next eligible for inclusion in the NASDAQ 100. So it's not the 100, it's the 100 to 200 that are out there. And what's interesting when you look at these is it's not just tech stocks, like United Airlines is the biggest holding, I think, and then there's Analem Pharma, Tractor Supply, eBay is a big holding at this point. I guess people want to know what's the next NVIDIA out there, and I know it's hard to figure that out, but you try to do that here to a certain extent.
I think those are companies, if you go back and look at when NASDAQ 100 was started, the median market cap was $500 million. Today it's $76 billion. So I think you look at the size of the companies that are in the next 100, they're still very large companies. So I think investors kind of want to know what is next. So NextGen, I think we look at companies that are on a growth path, and what is next? That's anyone's guess. But obviously, who's taking advantage of the latest technologies? I think I mentioned before the R&D. If you look at just dollar percentage, it goes for the Q spend is just enormous. So these are up and coming companies. Not up and coming.
You also got to cover it in terms of rotation too, because people are worried about so this tech is too much out there. There's actually a NASDAQ 100 equal weighted ETF that's out there. They got everything, folks. QQEW is the NASDAQ 100 equal weight. So it weights all 100 of them on an equal weight basis there. And, well, that's still heavy tech concentration even there, but it certainly spreads it out more.
It's just, it's going to be spread out the holding, the amount that's held. So,
but the money in that is much smaller, though.
It's a way to dial back concentration risk. And it's probably working out today, I'd say. Equal weight indices are having a better day just because NVIDIA took a hit right off of the AI news.